Maybe that's
I
why
don't even know
stocks are
why they
down
would
this week.
stick that out there unless they need to use the discount window at some point, or they're anticipating a need to use the discount window. And they're trying to slap some Orwellian lipstick on the act of using the discount window.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And it is Thursday, so that means it's my day to check in with Denver Dave Kranzler. And before we get started, go ahead, hit that subscribe button and the little notification bell right down there, which will allow you to stay posted, because fortunately, while JP Morgan is out saving the world and breaking stigmas, Mr. Kranzler is going to explain the virtuous nature of JP Morgan's business. I'm sure everybody is excited. JP Morgan breaking the stigma. So Dave, great to have you on here again today. And I apologize. I know you were probably writing thank you letters to Jamie Dimon, and I'm taking you away from that. But it's great to have you, and perhaps you could break this one down for us.
Is what he's doing, I guess he's breaking his stigma here. I mean, I guess that's analogous. I guess it's his version of burning your bra, like women were, the feminist movement was into burning their bras in the 70s. So I guess this is the 2020 equivalent in the world of modern finance. He's going to burn his bra or burn whatever he wears and break the stigma and start using the Fed's discount window. Maybe he's going to stop wearing underwear too. He's going to go free balling.
Well, that would certainly be an interesting market development. Maybe that's
I
why
don't even know
stocks are
why
down
they
this
would
week.
stick that out there unless they need to use the discount window at some point, or they're anticipating a need to use the discount window. And they're trying to slap some Orwellian lipstick on the act of using the discount window. I mean, the discount window hasn't been relevant for many, many decades with the modern financial short-term financing machinations, and so it evolved into something that was seen as something that banks use for emergency funds, and that's essentially how it's functioned. And that's how it functioned in 2008. Overnight lending, collateral markets seized up. So just go directly to the Fed window where they have a printing press behind the bulletproof glass, and show them your ID and take some cash. Again, it's breaking a stigma. I mean, now it's going to be politically correct to borrow from the Fed discount window. He's probably got a whole campaign on Facebook. Everyone's liking it, and it'll become politically correct to, you're a discount window racist if you don't borrow from the discount window. I mean, again, what it tells me is that he's anticipating the potential for a need to tap that source of funding. I mean, it's really become like I said, an emergency sort of, last ditch source of temporary liquidity. It's more expensive to borrow from the discount window than the overnight repo market. So, and the other reason I think is the discount window takes a wider basket of collateral than the Fed repo market does. I mean, the bank-to-bank repo market is a little more liberal in terms of, the collateral it'll take. And the discount window, I'm looking at the list of assets it'll take here, commercial and ag loans, consumer loans. I mean, JP Morgan's sitting on a tranche of Capital One subprime securitized assets, and they can't get anyone to lend against them in the overnight market, so they go to the Fed. Here, take this Capital One crap. Don't worry that the delinquency and default rate is approaching record levels for this asset class. Asset-backed securities, auto loans. There we go. There's another asset class that's performing worse now than it did in 2009.
I guess this
State
wouldn't.
or political subdivision obligations. I mean, maybe maybe J.P. Morgan's sitting on a chunk of industrial revenue bonds issued by the state of Illinois, and they're worried about their interest payments being made on that. So here, Powell, you take this, give us some money. And that's the only thing I can think of, is that at some point they're going to need to tap into it. They don't have a fortress balance sheet. They've got in another era, in an era where financial markets behave more prudently and the Fed wasn't printing money like a drunken sailor on meth, JP Morgan wouldn't even be sitting on these assets. So and in that era where it was much more prudent, 40, 50 years ago, JP Morgan's balance sheet would be considered a junk bond. All the too big to fail bank balance sheets would be considered a junk bond. So, again, it's just another bailout mechanism that the banks are teeing up. So, and whatever JP Morgan or his concubine who presented the idea at some conference, who let everyone know that he's rich and they're not. I don't know if you heard about that part. He dropped that in his speech. Whatever reason they're saying that they're using it for, that's not the reason. I guarantee it.
Well, I appreciate you mentioning that, because if I can read a quick quote here, the Fed discount window is meant to provide emergency liquidity to banks that otherwise have healthy balance sheets. In a cash crunch, banks can pledge collateral to the Fed in return for cash. Now, to me, that fits incredibly well with what's happening, more so than, here's a quote from Jennifer Pipesack, JPM's chief financial officer. We think this is an important step for us to break the stigma here. Now, Dave, given that we've already heard a lot of people comment that the repos, we hear JP Morgan's name pop up more so than any other bank as a potential reason for those repos. So again, the idea that we don't know what exactly is going on. Powell tells us everything is great, yet doesn't tell us what's going on. So we're really left to guess, but that was my initial reaction. Is this somehow the same, connected with whatever is that same issue, which we hear people reference JP Morgan in regards to the repos?
I mean, my view hasn't changed. The repo market seized up because a lot of the collateral on bank balance sheets that are non-treasury, non-agency collateral is starting to melt down. I mean, we're seeing that in the numbers, in terms of delinquency rates, default rates on auto debt, not just subprime auto debt, all auto debt, credit card debt, leveraged loans. I mean, JP Morgan's sitting on a big slug of leveraged loans that it was unable to syndicate in the frenzy of the leveraged loan orgy that went on for the last few years. And a lot of those companies now are becoming insolvent, especially and it's not just the oil and gas, the shale oil or alternative oil companies. I saw a breakdown of distressed leverage loans, and it was like consumer services or something like that. A consumer related segment of the leveraged loan market had the highest rate of delinquencies. So there's a reason why they're not telling us, exactly what is going on in the repo market. I mean, all we hear is that the plumbing's clogged or there was temporary liquidity. Well, temporary to me doesn't mean from September 15th to February 15th, extended out to April 15th and probably beyond. I mean, what are you going to define temporary as? Temporary for me means overnight, a week, a month, maybe at the outside. Not, when we get to April, it'll be freaking half a year. That's not temporary. Those are temporarily permanent loans to these banks, and it's essentially a bailout. And now, JP Morgan's going to lead the charge to make it okay to burn your bra and borrow from the discount window. Of course, you know, the cause in the 70s was a lot worthier than this cause. This is just going to be another outlet for them to dump their bad assets and get some printed money from the Fed that they can, you know, relever again and make the same stupid bets over again. You know, it's essentially removing, you know, all the guardrails on these banks have been removed. I don't care what anyone says about Dodd-Frank, it was useless. And these Fed stress tests are useless also. These banks are in trouble. And we're starting to see the signs of that.
Yeah, similar
it was
to how
happening before this coronavirus crisis.
Yeah, and reminds me again, as we've mentioned often, about how 2007, 2008, Ben Bernanke and Hank Paulson were telling us subprime was contained. Although perhaps the takeaway here, Dave, I appreciate that you dig into these things, and at investmentresearchdynamics.com, which is in the description below, where you also offer the short sellers journal. So people who don't want to get clobbered by Bernanke, Janet Yellen, and the gang can find out ahead of these things happening. So appreciate you joining me today, sharing that. Folks,
hey, let me just throw in one thing here. It's my pleasure. Always love chatting with you, Chris. People should just go to the Federal Reserve link and just read for themselves what the discount window is, and then they can make their own decision on what's going on.
Well, yeah, that's another good point, because you don't have to take my word or Dave's word. You can verify these things. They're out there in plain sight. And fortunately, Dave does help point out some of the things that we may not otherwise see. So with that said, thank you for watching today. And if you enjoyed this, then you're going to want to stay tuned for the video that's about to appear, where Dave gives an update on the gold market. So thanks for watching, and we'll talk to you soon.